SoFi accidentally leaked a part of their earnings results a month before the earnings. The management of the company got so excited, reaching 10 million members, that they basically fed the investors this sensitive information. And if you think about this for a second, growth in members year over year or quarter over quarter for an online bank is one of the most important indicators for the company's progress. So we've made some very simple calculations to check and see where the company is heading, and of course I will mention this today, but more importantly I will talk about other important indicators to look out for on January 27 or on SoFi's earnings. I will mention positive and negative catalysts for the stock of this company, and of course I will talk about what to do with the stock of the company under different market conditions and assumptions. Hey there and welcome to the Market Monkeys channel. It's Julia here, and first of all today I want to talk about this huge SoFi's milestone, 10 million members. This is an incredible progress considering that just 3 years ago they had less than 2 million members. Slow down and let it sink for a sec. The company grew more than 5-fold since the beginning of 2021. Now, using the knowledge that we already have, and after making some very simple calculations, we can see that in the last quarter alone, SoFi added at least 627,000 new members. Compare this to the same quarter last year, where SoFi added only 585,000 members, and you can see why this December announcement was such a big deal. Even if the pace of new signups slows down because of the holiday period, we can still expect year-over-year growth of approximately 33 to 35%, which is incredible. It means that their growth not only did not slow, but also slightly increased in the last quarter, despite the fact that as further the company increasing the quantity of their members, the harder it gets to grow and the growth rates get slower and slower, as we see from this slide. But here I must mention that this is not the most important metric to look out for on January 27 in SoFi's case, because the most important question is whether or not the company will be able to stand at the 50% revenue from lending, 50% revenue from financial services and tech segments. Before COVID, their lending segment was the biggest one, and it actually brought many problems for this company. Being dependent on the revenues from lending is a very risky thing for SoFi, because it actually means that the company's financial health is dependent on interest rates that are pretty volatile lately, and it means that in general the revenues and the profits for this company will be unpredictable and unstable. And this is actually what the company experienced throughout the COVID crash. So right now, based on the past experience, they chose to transition to fee-based revenue streams that provide stability and reduced dependence on economic cycles, and they're doing so by growing their tech and financial services segments, and it's actually working. As of third quarter, these segments made up 43% of SoFi's total revenue, a strong increase from 37% in the previous year. So the management's target is to reach 50% revenue from tech segment together with financial services, and if they will be able to achieve this ratio, together with the fact that we already saw that they beat the expectations in terms of new members, we might see the SoFi stock price appreciate significantly. If you find this information valuable, don't forget to support our channel by pressing a like button and subscribing. One more metric that I am following closely, and actually on this metric will depend whether or not I will be holding SoFi in the long run, it's their tech segment. This is the smallest and unfortunately the slowest growing segment in SoFi's business, but if this segment will grow significantly, for example, they will close some huge deal or close some nice partnership, this can bring SoFi's financial potential to a completely different level. By the way, for those of you who are not sure what I'm referring to, the tech part of SoFi's business primarily spins around Galileo and Technisys. Basically, Galileo is made to help banks by allowing them to modernize their backend infrastructure and tech stack, and thanks to Technisys, they have added cloud-native digital and core banking platforms to their technology platform, by this making their financial services more efficient. So when I refer to tech segment growth, I mostly mean the selling of Galileo technology to other institutions and hopefully the ones that will pay a lot of money for it. And why am I paying so much attention to this? First of all, because there are always many disputes regarding whether or not SoFi is a fintech company, and investors who are bullish on this company are claiming that this is indeed a tech company and the high valuation of this stock is actually justified because of this. And even the CFO of this company referred to their tech segment as to AWS of fintech. I'm not convinced myself about the tech part of their business, so I would very much love to see the company proving to everyone that they are indeed a tech company and putting a fat dot on this topic. Another reason to pay attention to this is because tech services are much more scalable and profitable. Imagine if they will sign some big deal, it will not only bring them to their goal of 50-50 revenue mix, it will actually change the sentiment of the whole market of analysts and will send the stock price up. By the way, Citi have raised their target price from $12.5 to $18 per share. They're keeping a buy rating on the shares as a part of a 2025 preview for, pay attention, financial technology sector. And they say that investor interest in fintech continues to grind higher, echoing improvement in sector performance since the US election. First of all, it's great news. $18 per share is almost the highest prediction the Wall Street has seen. The highest is actually stands at $19 per share right now, and the average is being around $12. But what is more important, they are saying that SoFi is a fintech, and many analysts on Wall Street have been expressing their disagreement with this term. So basically, if the company will be able to prove themselves in their tech segment, it could actually change the analyst price targets, and as a result of this, again, the stock might go up. Now let's zoom out to the macro level, because the recent pullback in the stock market made all of the investors nervous, especially investors in the high growing stocks like SoFi. So the interest rates is a double-edged sword for SoFi. First of all, the high interest rates were pretty good for SoFi's deposit business, but from the other point of view, they are pressuring this lending segment of theirs. But even if not to take this into account, low interest rates are already a part of SoFi's high valuation. The gossips about rate cuts have been in for some time now, and Trump has not once said that in his opinion the rates are way too high and that he will be pushing towards their cut. So of course SoFi's stock price is already reflecting those hopes for the cuts, and of course investors are expecting to see an increased lending activity due to low rates. The high demand for the loan refinancing, which is a huge part of SoFi's business, for example their student loan refinancing, and the lower cost of capital, which boosts the revenues of SoFi. So basically right now with all of the news we see that the rates probably won't be cut by as much as it was expected. And if Fed actually comes up and says that they will cut the rates by some very small percentage, it will definitely be a dark day on SoFi's calendar. In recent weeks, SoFi experienced valuation pressure as well. The rise in long-term bond yields has put a huge pressure on high-growth, high-multiple stocks like SoFi. With a forward PE gap about 100 times, SoFi is priced significantly higher than its consumer finance peers, which trade at roughly 13 times. This makes the stock very sensitive to the market volatility, but in the situations like this, I suggest for everyone to calm down and to wait until the market is sane again. So my strategy for the SoFi stock is definitely to wait and to see what will happen after the earnings, because in my opinion the chances for the stock price to grow significantly are higher than the chances for the stock price to drop significantly. So basically I'm not saying that stock cannot go down, it definitely can, but in my opinion there won't be any catastrophic decline, because first of all we already saw that they added a lot of new members and they actually beat the expectations for the past 4 or something quarters, so I don't think that we will see some major decline. In general, I am planning on holding this stock until minus 20% from the top, simply because I bought it pretty early and I actually wanted to sell it at $11 per share, but the sentiment of the market changed. So I saw that people are loving this company and decided to stick around just for fun, just to see what happens. So right now I'm taking approximately $16.50 per share as the highest point, so minus 20% it will give me $13.2 per share. By this strategy I'm not exiting too early, and I'm also not trying to catch the highest point. By the way, if some major correction will occur or some major big news will come up, SoFi will be one of the first positions that I will close completely, because they're highly volatile and highly risky stock. Vadim has explained his strategy for SoFi's call options in our previous video, so if you haven't watched it, go and do this now. Don't forget that everyone has different strategies, everyone has different risk tolerance, and everyone has different assumptions. Make sure you do your own due diligence. Don't forget to support our channel by pressing a like button, subscribing, and I will see you on our channel next time. Happy investing!